All right, welcome to USS Investing's exclusive uranium podcast. I'm your host, Levi Brandstetter, founder of USS Investing, and I'm joined today by Andrew Weekly of Smith Weekly Research and Matt Geiger of MJG Capital. Thank you guys so much for taking the time to do the Q&A today.
Thanks for having us, Levi. It's great to be on.
Yep. Yeah. So to start things off, Andrew, do you want to give us a little bit of background on how you got into investing and then kind of what you're doing now?
Yeah, sure. So I would say my first time I had ever bought a stock in my life was probably around 2003. And then did a number of investments personally for a while. And then in 2007, formed the Smith Weekly Group. And then we got into the newsletter business in 2012, and then got into natural resources in 2015. And then we published a large report on uranium, nuclear energy in 2017. And so I guess 2017 would really be the official bullish date for us on uranium. And so we continue to write our newsletters monthly. We have a radio show and seem to do a bunch of stuff and very busy folks full time. It seems like 16 hours a day doesn't quite cut it, but we're busy. And that's pretty much what I do with most of my time.
That's great, Andrew. And for all the listeners out there, be sure and check out the 2019 nuclear report. I had the chance to read the 2018 version, and it's super good. And also, Andrew does a ton of recordings with CEOs from all over the industry, which are really, really invaluable for your retail investors. So thanks, Andrew. And then for Matt as well, how did you get into investing and what are you doing now?
Sure. So I manage the MJG Capital Fund based out of San Francisco. We're a limited partnership focused exclusively on natural resources. Right now, about 85% of the portfolio is focused on mining, and then about 15% in agriculture, forestry, aquaculture, and other non-hard asset resources. We're a smaller fund, but very patient capital. All LPs, and we have about 25 of them in the fund, have committed their capital for 10 years. So there's a 10-year lockup. And so we take a very long-term approach, a counter-cyclical approach. And because of the structure of the fund, we can out-survive others in really bleak markets, including the bear market that we went through between 2011 and 2015. So in terms of how I got interested in investing, it's probably through poker, to be honest. I love the concept of speculative value. You know, I played weekly for about 5 years of my life in middle school and into high school. And, the concept that you can make bets with a 70% chance of failure. And these bets can still be very rational as long as the payoffs are large enough to justify the risk. I think a lot of people in this world are scared of being wrong, but in investing, being wrong some of the time is okay. That means you're potentially taking enough contrarian risk that can lead to outsized returns. So, I would say poker was one of the big inspirations growing up. And in terms of how I got interested in natural resources in particular, I've always been a big fan of anthropology, with Jared Diamond's book Collapse as one of my absolute favorite books. And from my perspective, I'm a younger guy, just in my upper 20s here. I've always, the natural resource thesis has made a lot of sense to me. I don't think it makes sense for our global population to be growing exponentially, and for global consumption on a per person basis to be growing exponentially at the same time. Something has to give. And I think this is a reality that the world will start to realize over the coming decades. So, even though mining in particular is viewed as an antiquated, old-fashioned industry, I know for sure that 80 years from now, it's going to be just as relevant as it is today. There's also a dearth of talent, especially for younger folks. So I think it's a pretty interesting place to be investing for the long term.
That's great, Matt. And for all our listeners, Matt writes some really good semi-annual letters, and I've really enjoyed going through those. And they're both great to learn more about MJG, but also just develop yourself as an investor. He has some great guides in there about how to value companies, how he looks at the market. So it's really great. So let's jump in here to section 232. Thanks to Angel M and Benjamin H for the questions on section 232. And we're going to start off with Matt. Here's the question. I've heard that section 232 causing a global impasse in the uranium market. Some argue it is not only relevant for the US, but also for the global industry. What's your take on the global importance of section 232, and is it keeping foreign utilities out of the market?
Well, I think it is. I think it is globally important. I mean, heck, the United States has 98 operating nuclear reactors across 30 different states, relative to 350 reactors outside of the United States. So, in terms of consumption of U-308, we consume about 25% of uranium produced globally. So, I do think that any structural shift within the U.S. market is going to have global implications. It does depend on how and if 232 is implemented. Obviously, if Trump went with quotas, that would have a larger effect on the global market. Tariffs maybe less so. And I think if there is action on the 232 front, we would see a bifurcation between the spot and the contract prices in the United States versus the rest of the world. So I'd expect pretty quickly for U-308 prices within the United States to jump into the $50 to $60 range, which I'd view as kind of the incentive price for more domestic production to come online. In terms of the foreign utilities waiting for 232, I personally don't. I'd be interested to hear Andrew's thoughts. I don't have a compelling reason for why they would wait for the 232 decision to come into effect before signing long-term contracts. I think part of the reason we're seeing a lack of long-term contracts announced is that inventory positions for utilities outside of China are still between 2.5 years of inventory. So decision makers aren't panicking quite yet. And then additionally, the utilities in general are complacent after nearly 8 years of falling U-308 prices. I think they failed to recognize that we may not be in the $20 range for all too long. So I don't know if the lack of long-term contracts really has a good reason to wait until after 232. But humans don't like uncertainty, and so that could be part of the reason why these utilities, both domestic and foreign, are sitting on their hands and waiting for a resolution before making the next move.
That's great. Andrew, anything to add there?
No, I think Matt did a pretty nice job. My comments would just be that the European utilities and a number of other utilities outside the U.S., there's not a need to contract at this moment. If you look at their inventories, there's just not a need to do it right this moment. I would say that 2020 onward, including all the way out till 2024, there is needs by various utilities to recontract. So 232, I agree that there probably is some utilities internationally looking at or talking to the U.S. utilities about this. And, I'm sure they're talking back and forth. But if you really look at the situation right now, I don't know that internationally anybody needs to really pull the trigger in a substantial way yet.
And then on Section 232, I think we've kind of seen a split based on whether people believe it's going to be an economic or a geopolitical decision. I think you've seen utilities make some arguments on the economic side that, maybe it doesn't make a whole lot of sense, but you've seen the petitioners argue that geopolitically it does make a lot of sense. So in your perspective, Andrew, do you think it's going to be an economic or a geopolitical decision?
I think it's a mix of both. I think you can't have those two terms separated. I think that the implications are kind of going to be far-reaching. Obviously, Matt already discussed some of the issues there, but I think also it sets up pretty much a completely different market. I mean, you have Trump looking at the economics in the United States. Obviously, it's all about jobs and trying to get that unemployment rate even lower than 4%, which, again, I argue it doesn't have anywhere to go but higher eventually. But nonetheless, it's certainly an economic issue that will be decided upon, and that means jobs. I don't think Trump cares that it's going to cost just a little bit more for the utilities. It's insignificant, the increases for the fuel domestically. And then outside the United States, I think it's a statement to Russia and to some others that the United States is going to maintain, at least minimally, a domestic uranium industry and a fuel cycle. And I think that's critical as a country like the United States that's trying to continue to hold on to its dominance as a world power while continually being chipped away at by Russia and China. I think that there is a situation where keeping this system and infrastructure in place domestically is really critical. And so that's my view on it. And I think that both of those, all of those comments mix in with both geopolitical and economic.
Perfect, Andrew. That's great. Matt, do you have anything to add there?
I do. I mean, I think it will ultimately come down to the actual decision. And then we'll know whether the economic rationale won out or more of the political.
Right.
I mean, as Andrew mentioned, from the utility perspective, if there was a 25% quota or tariff put on uranium consumption, that would marginally increase electricity prices in the 30 different states that host nuclear reactors. And so some would argue, and the utilities certainly are, that would put a damper on the U.S. economy and could help possibly stifle GDP, et cetera, et cetera. So that would be the utility argument. And if Trump ends up not pushing forward with tariffs or quotas, we'll know that one would have won out. If we do see action, then I would call it more of a political decision, not necessarily a geopolitical decision. I think this is a great opportunity, particularly with how much President Trump talked about Uranium One and Hillary Clinton during the campaign, to revitalize that whole debate and draw a strong contrast between himself and Clinton, which himself and a lot of his supporters believe, gave away the U.S. uranium industry to the Russians. And so if he's able to revitalize uranium mining in the United States, that would be viewed by many as him following through on a promise to make us more energy independent. And then additionally, he's, supported miners across the board, whether we're talking coal or uranium. And this is another opportunity to emphasize that. So I think if we see action taken, it will be more of a political decision to boost approval and follow through on some of the campaign promises that he made.
Well, let me just go back for just one sec and make a comment in addition to what Matt said on the last question. It's just simply that if the gas price rises a little bit in the States, that is much more of an economic problem than a very small increase in a power bill where a nuclear utility goes to the public utility agency to get a raise in the rates for electricity. So people feel a lot more pain with the oil market and a little bit of movement in oil price as compared to what this Section 232 could cause. So I think it's important to keep it in perspective.
Right. That makes a lot of sense. The next question we got was concerning Cameco, and this one's going to be for Andrew to start out on. I've heard some saying that Cameco is being valued by the market at an implied uranium price that is quite a bit higher than the current spot price, and so it doesn't offer a lot of upside. First, how can one know that what is the implied uranium price in market valuations? And then the second part is, do you agree that there's little upside in Cameco?
Cameco's arguably the only Western listed company. Kazatomprom does not fall into the Western category yet, although I think that they're making very good moves in that direction. What I would say is it's the most liquid, and so when people start to come into the space, people will look at safety. They will look at the top big companies in the sector, and really the only choice is Cameco. Now, while I don't own Cameco personally, and I don't know the risk tolerance of all the listeners, but I would say that Cameco is portrayed as a safe company that is Western and has liquidity, listed on the New York Stock Exchange and, of course, in Toronto as well. And so on the upside of Cameco, is it limited in comparison to other producers, explorers, and others in the space? Well, certainly, absolutely, I think it is. Could you have a threefold increase in Cameco share price just because of the amount of liquidity that it can attract? Absolutely. I think that a threefold increase is quite conservative for Cameco, and I think people can do well at these prices. It will take some time, but that's my 2 cents on it.
Thanks, Andrew. What do you think about Cameco, Matt?
Yeah, Andrew took the words out of my mouth, especially that 3x increase. That's the number I had in mind as well. I have nothing against Cameco. It's not in the MJG portfolio. It probably won't be. There are other well-managed companies out there that I think provide more torque to increases in the uranium price. But it absolutely will be a go-to name, especially when, Wall Street institutions start getting interested in uranium again, as they've already started to some degree. So I think a 3 to 4 possible over the next 5 years. Things go to plan. Cameco absolutely has some of the very best uranium assets globally. But yeah, you're not going to get, 10 bagger potential per se that you may with some other well-managed juniors that are out there. So not a holding of ours, but, a good safe spot for uranium exposure. And I think there's still plenty of upside over the coming few years for Cameco shareholders.
Perfect. And that really leads me into this next question. And this is why it's great to have you guys on here, because you guys are talking to executives, you're in the room, hearing from a lot of other investors. And so I think you really do have a good feel for sentiment on the sector. And so the question is, we've kind of seen this, the uranium price go from rock bottom of 18 up to 28, 29 where we are today. Some would say sentiment has came right along with it. So my question is based on your experience, do uranium equities currently reflect too much optimism, or do you think there is a lot of room to surprise to the upside and that sentiment really hasn't caught up? And we'll go with Matt on this one first.
Absolutely. There is some rise in the uranium price already built into some of these equities. You'll see the economic reports being put out, especially by Athabasca-based companies using $45, $50 uranium. And that's not assuming the spot price, which is generally what you should do with these economic studies. So I think the market is anticipating a rise to some degree. But that, the space has been so contrarian for so long, just beaten down for 7 straight years since the Fukushima disaster. I guess 8 straight years at this point in February 2011. And I do think there's room to run here. I don't know how quickly the price will move, but I do think in this cycle we'll see at least $50 to $60 uranium, just because that's the incentive price in order to get some of these decent projects up and running and into production. So, there is a deficit coming in the next, we'll say 24 months or so. And price rises are to be expected here.
Awesome. Andrew, how is sentiment looking from where you sit?
I think it's a little bit delayed and slowed down a little bit with Section 232 has literally stopped the spot price from moving notably. And so I think that there's investors are getting, certainly some people who don't have the patience to hang around are probably getting a little bit frustrated at these levels and at this point. But if you go back and you take a look at the sector in 2016, when uranium had hit $18 a pound, I think you'll find that most of the companies in the sector today are trading at higher highs and higher lows as compared to 2016. Now, some of them have come back and given back almost everything. Some have performed okay, and then there's a few out there that have performed quite well. So I think overall, there's some strong hands out there. Obviously, we're seeing higher highs and higher lows, but I think also people might be disappointed that it takes some time. We might still be on this for a while before we start seeing that real breakout in uranium prices. So I think the equities will follow extremely well. It's just a matter of when that sentiment really comes back and people really get on board.
Yep. I will add, there's been 3 to 4 head fakes as well over the time period that Andrew mentioned, since 2016, where spirits for at least a few months at a time have gotten euphoric only to recede. So I really do think those getting involved with the space for the first time now need to be bullheaded, need to have a 3 to 5 year timeline, and not get sucked up into the weekly price fluctuations that we see.
Definitely. Yeah, we've definitely kind of seen a couple. I think of Western uranium has had kind of an up and down. Plateau and Peru has kind of had an up and down chart. So we've definitely seen kind of a couple waves already, even in the last 6 months of optimism and kind of maybe rampant optimism, and seen that kind of crash down a little bit. Look at
GoVX. Look at GoVX as well. Rally close to 30 cents after a 10-cent placement in, I believe, in 2016. So now the share price has almost fallen back to the placement price. I think it's in the low teens at the moment. So there have been quite a few head fakes, and you need to take that longer-term view, not get too discouraged and not get washed out of the space, because the bigger move is still coming here, that's for sure.
That's great. And what do you guys think about the Section 232 sentiment? I think you've seen energy fuels move up a little bit, but I think you could argue that UR Energy and UEC maybe really haven't had a run yet that you would say a lot of that uncertainty is priced in. But I would be interested to hear what you guys think, and maybe Andrew, you can take this one of, have the U.S. companies started to price in the Section 232, or what are you seeing there as far as on the pricing?
Well, I think it's hard to say exactly. I think that there's always a little bit of unknown situation there, I think, with regards to these. But I think if you look at Energy Fuels, they have the vanadium component, and so that is starting to help out. And speaking just to producers, I think Energy Fuels is really that only one that has that vanadium component. And on top of that, let's face it, Energy Fuels is the largest company in the U.S. as a producer focused. They have the most liquidity. They're New York Stock Exchange listed. They're the best one there from a number of fronts. And they also have a fantastic leadership team there that's been in the business for a long time and has huge experience, not just in the U.S., but outside the U.S. as well. URG, I think, is in a special case right now, given that they could see a nice performance. And if you look at their market cap, I think that URG is underperformed, and they have maybe some outperformance and catch up coming. As far as what I can see, the company is quite well set up. UEC's got some different components going for it. With, of course, all of these are New York listed, but, URG and both UEC, they're a little bit less on the liquidity side than Energy Fuels. But I think UEC at these levels could potentially run. I mean, it's come down. It hasn't come down, back down to like 90 cents, where, I would consider picking it up again. But, UEC has some other options. They have some other issues related to their projects, some of their acquisitions, and of course, some of their non-uranium projects outside of the United States. The status of those is a question. We haven't heard much on that front. But, the company has a huge promotion base. I see Uranium Energy Corp do a lot of promotion, and maybe that promotion is what maybe gets interest back in the stock. But I think at the end of the day, I think that URG's got some time to catch up to Energy Fuels, and I think Energy Fuels is pulling all the levers correctly to continue to move.
Perfect. Matt, do you want to make any comments on any individual U.S. names here?
No, I think Andrew was pretty thorough there. I mean, I think we're going to see mass buying for all three of these names if we do see 232 with a positive resolution for the uranium miners. The MJG fund's preferred exposure to 232 is through Energy Fuels. We actually own the publicly traded warrants and have done so since late 2017. So not a recommendation. All your listeners have different investment preferences and risk tolerances and what have you. But I think Energy Fuels, regardless of the set of what happens with 232, obviously there would be a share price decline, I think, in the aftermath if there was not positive news. But I think they are well set up for the years ahead, with their vanadium production and with the optionality provided by their uranium assets, with or without 232. I think they are in pretty good shape. They also have a somewhat healthy balance sheet here as well. And I like to see companies, I'd only consider buying common shares of uranium companies that have at least 12 months of runway before they need to come back and raise money. Otherwise, if a company needs to come back and to market for a financing in the next 6 to 12 months, my preference is always just to sit on my hands, wait for that deal, and then evaluate it as it comes. So Energy Fuels is one of them that I'm willing to buy in the open market at the moment due to their working cap position and the cash flow they're starting to see from vanadium.
Perfect. Thanks for sharing that. The next question we have is referring to valuation, and it comes from Brett A. And his first question is, I love the quick introduction to assessing companies as a potential candidate for my investing dollars. And he'd be curious to know about putting target prices on a company once he's decided it's worth an investment. So Matt, do you use target pricing a lot in your investment process, or are target pricing just not really a big deal for you?
I do. I mean, I think if you come from a value tilt, even if you can't get an exact number or a precise number, you should always have a target price in mind. You should always have that upside scenario. And it really depends. I view this much more as an art than a science. Of course, you also have to look at other variables like the balance sheet, ownership structure, insider ownership, many other variables. But generally, anytime we make a new investment, I do have a target price in mind. I usually want to see at least 100% upside from the current price to the target price. We're in a risky segment of the market in mining and junior resources. and you want that upside to compensate for the risk. So it doesn't make sense to me to buy something if you only see 20 or 30% upside. So it really depends. I mean, there are all sorts of business models in the mining space. I can kind of go through the list here and throw out a few examples, hopefully helpful to your listeners. In terms of operating mines, the best case scenario is to always build out a discounted cash flow model when and where possible. You then want to divide that by the fully diluted share count, and you can get a good feel for what the per share value should be relative to the company's current share price. Of course, if there's a big delta between those two numbers, and as I mentioned, hopefully at least 100%, there can be an opportunity there. Additionally, and this is another way to look at it, you could do a peer comparison on an EBIT to enterprise value basis. It can also be an appropriate metric. And you can look at your target company or the one you're considering investing in relative to its peers. And in some cases, you'll see the company you're looking at trading at much lower multiples than peers. However, at that point, you have to stop and scour, all information you can to find out if there's a legitimate reason why this company's trading at a lower multiple, whether it's a big debt load, profligate or inexperienced management, extreme geopolitical risk. But if you see a large disparity in multiples and there isn't a reason that you've been able to determine why, that could be an opportunity. And you could look at multiple expansion as a way to set your target price. So that's another way to approach it. And then in a final way, for an operating company, you can also look at the enterprise value of the company. It's market cap minus cash plus debt relative to the replacement value of the company's assets. Again, that's only relevant in certain cases, but that could be one way to set a target price as well. If you're looking at a development stage company, that's generally a company that's discovered a mineral body and is trying to advance it to production. What I like to use is a risk-adjusted discount to the most recent economic study. Again, this is more rule of thumb. There's no tried and true exact numbers.
Right.
But generally, what I use is I believe that decent projects at the PEA stage should be trading at roughly 10% of the after-tax NPV using a reasonable discount rate. For PFS stage projects, I usually look for the company to be valued at 20% of the after-tax NPV. For feasibility level projects, I'll usually look for the company to be valued at 30% of the after-tax NPV. And then when a project's under construction, generally you'd expect to see it valued at least 50% of after-tax NPV and potentially closer to 100% if that asset's nearing first production. So again, these are very back of the envelope numbers, but if you're looking at a company and you see a massive disparity, maybe it's a feasibility level project with decent economics, but it's only trading at 8% of after-tax NPV, that's something worth looking into. And there may be a reason why you want to look for those critical flaws. But if, after scouring and talking to your sources and talking to management, there's no clear reason why, there could be the opportunity for a re-rate there just based off of the stage of the project and its valuation. Switching to royalty companies, generally I'll just look at the price to cash flow multiple between peers. It's a pretty well-regarded metric within the royalty names. Again, this is more of a peer comparison with royalty names. When I see a big disparity between, say, a junior royalty precious metal names and some of its other junior precious metal peers, that could be an opportunity. You, again, want to scout out the reason why. There may be a very clear reason: inexperienced management, low insider ownership, big debt load, exposure to only one or two producing mines, et cetera.
Right.
But if you can't see a clear reason for that discount, then you can pretty easily find a target price by assuming multiple expansion to the peers median and then go from there. And, if the upside's big enough, that can be exciting. For the prospect generators, which is kind of a more niche business model that maybe some of your listeners are familiar with, there are a few ways to approach it. I would just say, to keep it simple in this current market environment, especially after the painful 2018 that we've underwent, on a sum of the parts basis, so that's simply adding a company's cash, marketable securities, gold bullion, et cetera, just looking at its working capital, net any liabilities, there are quite a few prospect generators out there with a negative enterprise value at the moment. And so again, as I've mentioned, continuously, you have to try to find a reason why. But assuming competent management, none of these prospect generators in my mind should be trading below their liquidation value. Some of them are right now. So that can be a way to kind of get value from a classic, Ben Graham style investment mindset. And then finally here, the explorcos, and generally that's not my preferred business model. I would rather have a prospect generator where, they have 3 or 4 senior miners or larger parties earning into projects, less dilution, less risk. But there are some explorcos out there which are focused on a single property, very binary. They're either going to hit or they don't. This is much more back of the envelope than anything I talked about. Usually the best you can do in these scenarios is look at what the best case scenario is. If they discover what they're looking for, they get the permit they're hoping for, what have you, whatever the key event is, decide what the best case scenario is based off of other peers or other companies that have recently done the same thing, and then multiply that by the percentage chance of success. And you can get an expected value for what you think the company's doing. So, if they have a 10% chance of hitting a, mineral deposit that may be worth $200 million, just very back of the envelope there, would say expected value of 20 million. And if there's a massive disparity between the current valuation and what you think this expected value is, it's worth looking further. And that can be a good opportunity to find undervalued investments.
That's great. Listeners, I hope you had your pen and your pencil out, because you just got a knowledge boom. So
yeah.
I hope you're able to, That's great. Andrew, to ask you kind of how do target prices work for you? Is it a big part of your process as well? Or are you not so hard and fast with target pricing?
Well, I think Matt did a good job of covering more than just target prices across the board. I think he has a number of metrics that make sense to at least using as part of a overall strategy to evaluate. I would also say, and Matt can agree, that sentiment is also a big key. So due to certain sentiment features that happen, especially in places like natural resources and places like uranium, I think that complete unexpected situations can occur in these equities in terms of price. And certainly in these equities, price is very important. With regards to target prices in this sector, no, I bring myself to use it. I just think that, target prices, to clean it up, target prices are like, opinions, everybody has one. And so for me, we don't specifically look at target prices. I mean, we do consider market caps and a number of other things that go into companies, management teams, capital burn rates. Obviously with exploration companies, it's pretty simple that, well, actually, let me just go back. In the entire uranium sector right now, everybody is consuming capital.
Right. Yeah.
And so you can't, it's tough to take. You can't come in and say, you can't come in and apply your valuation for a McDonald's or a Hershey or a Coca-Cola or a Pfizer. You can't come in with those types of metrics and apply them to the sector. Some you can. I agree that certainly some you can. And I think Matt touched on the ones that really matter in this sector that you can use as part of your overall tool set to come up with a decision. But no, we don't use target prices at all. We just don't have that view, because in most cases, especially with these analysts, these so-called analysts that cover companies in the big market, once the company hits the target price, guess what they do? They go out and they change it. And most of the time it's higher. So it's just, it's one of those things that we just don't see that there's any need, especially in the natural resource market across the board.
Yeah, I would take all the analysts' target prices with a massive grain of salt. Most likely it's a company they like and they want to bake in 20 to 30% returns, and then they reverse engineer a model to get their target price. I will say maybe a better way to frame it. I do think it's important to have some price in mind, whether you consider it as a target price or a price where you consider taking profits. Think about a target price as once your company hits that number, even if it's just a ballpark number and you can't get it down to the exact cent, you know that the company's gone from undervalued and compelling to fairly valued. I'm not saying that you sell immediately, but that could be a cue to start looking for exit opportunities. So, maybe target price isn't the right word, but I think investors, anytime they're putting money into any investment, should have a number in mind where they're going to consider taking profits in the future.
I think, yeah, I want to add a few to what Matt said there. For us, when we look at these, especially again, the topic here in this conversation is uranium. We look at macro factors for us when we come out to figure out where these companies are headed. We're going to look at the uranium price. We're going to look at these supply demand figures. We're going to look at sentiment. We're going to look at a number of different things, where we are in the cycle. And so for us, we're going to let the companies run. And again, I'll just say one more thing too. I'm not interested in the uranium sector to earn 100 to 300%. We've already done that. If you go back to 2016, as Matt mentioned and I mentioned, we've already done that. If you're there and you're playing a little bit of trading, you've already been able to achieve those gains, and in some cases much more than that. And so we're here for, and I think Matt agrees too, that we're here for a much bigger gain. Otherwise, I'd happily go buy McDonald's and wait for the dividends. But for us, it's certainly the focus on uranium prices, the supply demand, the sentiment. For us, let the companies run. And again, for producers and some other companies in the sector, yeah, like physical uranium funds. I mean, obviously the upside on those is the underlying uranium price. When we look at these smaller exploring companies, there's a number of factors that fall into it: discovery, upside, where we are. For example, the fattest example out there is NextGen. NextGen discovered a world-class deposit in a bear cycle. And as a result, it's evident that stock has been constrained because of that timing. And it's just too bad. It's too bad, because I think it would run a lot higher. And so now you're hoping for a new cycle to come in, or we're getting into the bull cycle. It'll be interesting to see how that is managed going forward. But that is a perfect example of a situation where sentiment kept it constrained. The supply demand fundamentals kept it constrained. All of the above factors kept it constrained. And so for us, just going back to it, I think that, and we cover it substantially in our report. And again, I'm not trying to sell the report here. This stuff is out there already. You can go find the report. I'm sure many people, we had it for free the first year. Many people have copies of this report, but we cover a set of fundamental factors in our thesis for uranium that would be a trigger, an alert, an alarm to sell the underlying stocks. And so anyway, that's just my 2 cents on it.
No, that's great. I think just knowing, it's not taught a lot of, but selling is almost harder than buying these stocks. So it's great to have kind of idea going in of what you're trying to achieve and kind of the returns you need to get there. So our last user question here is from Chris C. And sorry for the whiplash, listeners. We're kind of hitting topics left and right, but I hope you're having fun kind of following along. So this is a question about Russia and China. And the question reads, if Russia and China both want to vertically integrate in regards to their nuclear plant construction and their fuel rods and also the demand side of uranium, who is left to drive the prices higher and higher? Western countries appear to be quite fine in regards to their nuclear output, with only a minimum number of new plants in the works. So, Andrew, what do you think about that?
Okay, well, yeah, this is a longer question, can be construed in a couple different ways, and we didn't get a chance to clarify it, but I think we've got the gist of it. So it's evident that China, specifically Russia gets the trophy. There's no doubt that Russia is really pushing on a global basis to increase their market share of the complete nuclear package globally. That means, fuel cycle, offering technology and commercial reactors to other countries, financing them, offering up the teams to operate them, construct them, do everything. And just, it's great. It's a fantastic model, and nobody else is out there doing it. And it's kind of sad that other countries haven't figured this out. But anyway, to back to the question, I think that when you look at that, right now, Russia has a number of off-market, supply sources that they're able to generate uranium from. But you haven't seen Russia step out and buy, really get involved heavily with, some of the listed, equities and buying projects. But we've seen that with China, and China's come out and purchased a number of projects outright. They've taken controlling stakes in companies, which is an arguable situation, maybe another topic for a different discussion. But, China kind of takes a controlling stake, and these companies are more or less controlled by the Chinese, which from a publicly traded standpoint, I see that as a negative. I've looked at a number of these companies that have these controlling interests, and if there's a big Chinese investor involved, I tend to look the other way. The only place that I've gotten lucky to not have that opinion is when you invest in a company like an Ivanhoe Mines, obviously led by Robert Friedland. Somehow Robert is able to work the Chinese like nobody else. And so that has worked out really well. So I think it also matters the Chinese group that you're dealing with, because there are some that can cause these publicly traded equities to turn into a corpse, whereas there are some great Chinese investors, great Chinese groups out of Hong Kong and some other groups that have a different view. So that's that side of it. Now, with regards to the purchases of uranium by these entities or these countries, obviously Russia is very difficult to get a handle for what they're buying in the open market, whether it's via spot or long term. But the Chinese, there is a track record with the Chinese, and this will also be a little bit of a subject in our report, in which that we've made a chart for it. But the Chinese have purchased from Canada, Cameco specifically, a lot from Kazakhstan, Uzbekistan, Namibia, of course, because they have some controlled assets there. And also Australia, I would also add to it. There's a couple other countries. But so more or less, the Chinese are looking to grow, in my view. They're looking to grow their holdings, not short them or not sell their inventory. China is inventory building, in my view, and it's evident that's what they're doing if you look at the statistics. And Russia is really in that same boat. I don't think either of these countries, which happen to have a nice inventory, by the way, compared to Western countries, I think these guys are accumulating. They're not there to sell. And so with their implementation of a complete nuclear package, from fuel cycle to plant construction to financing to the whole mess, I regard that as good. I think that's positive, because ultimately the Chinese have demonstrated that they can't do it themselves within China. They've got to step out and buy other assets, which they've been doing. So I really see that. I just don't see an issue here. I think that it's overall positive, and I would just suggest that the United States get involved and try to take some market share of developing out emerging nation nuclear power infrastructures. The United States should be more involved. Right now, Russia has a substantial piece of that. And so anyway, I think I covered most of the premises that question answered, and I'll leave it there.
Well, thanks, Andrew. That's great. It's a big question, so thanks for taking a chip out of it and kind of touching on some of those topics. Anything you want to add, Matt?
Yeah, I'll keep it short. I mean, we're uranium investors at the end of the day, and of the MJG fund, about 15% of the fund weighted is in uranium equities. So to be perfectly honest, it doesn't matter to me who's building the reactors, whether it's Chinese firms or Russians going into the Middle East to build the reactors. I think it's a shame as an American that, Westinghouse and, a lot of the leading nuclear reactor engineering firms have kind of fallen by the wayside. But from a pure uranium perspective, those reactors are going to demand uranium, regardless of who builds them, regardless of which engineering firm is behind it. And that uranium will be coming from Kazatomprom, and it will be coming from the Athabasca Basin, and it will be coming from Africa. So, from my perspective, I'm more interested in the actual growth of the reactor build out, and less so about who's building them from a pure investment perspective. In terms of the next big catalyst for the demand side, there's kind of two different competing camps. Someone like Rick Rule would say that the number one demand catalyst here is restarts of nuclear reactors, where we still have, close to 70% of the reactors offline at the moment. Others are in, kind of Mike Alkin is more in the, China and India camp in terms of driving new uranium demand. To be honest, I don't think you necessarily need to pick a side. Immediate term, the biggest potential catalyst would be restart of for more of these Japanese reactors.
Right.
The restart process has gone slower than many expected, and I think we're just maybe at 12 reactors now online, if I'm not mistaken, out of a potential 40. Over the next 2 years, we could move pretty quickly towards that 40 number. I think Japan's making a pretty big mistake by leaving these reactors, mothballed and wasting all the fixed cost and energy and effort that's been put into constructing them. But yeah, over the next 5 to 10 years, more so focused on new demand from India, from China, from the Middle East, from some of these new reactor build outs. So I don't necessarily want to pick a side in the debate. I think both are positive and constructive for the uranium price, and I'll leave it at that.
Perfect. Well, thanks for that, Matt.
Yeah, I'd add a little bit to what Matt said there, and I agree, Matt. Again, we're uranium investors. I do care about nuclear a little bit. I think that it really is a key force for solving a lot of issues, and I think that it makes a lot of sense to have it around. But for us, again, yeah, we don't necessarily care about where the demand's coming from as long as it's coming, and. With regard to Japan, we've seen some mixed stats out there. The EIA has a little bit different stats on that. I think that Japan right now, if we're lucky to get to half or maybe a little bit over half of the reactors restarted, that would be a target for me if I had to throw that word out there. I think that would be a great place to be, because there's a number of reactors that have really, the status has not been really completely publicly disclosed in terms of we're going to try to restart this, or we're just going to shut it down and forget it, or it's already shut down. We're just going to dismantle it and forget about it. And so if we can get back to the 2024 number, I think that would be absolutely fantastic. And so, but again, that really, given the amount that are coming online in other countries combined, it's really not really that important. And so, aside from that issue, I think that the big key, and again, the demand will come. There's no problem there. It's obviously proven that the demand is coming in the short term. And by that, I mean 5 years. Really, the catalyst is the long-term contracting cycle. And that is, again, 2020 through 2025, 2024, that period there. The question is, how can you get those contracts filled? At what price? And who will actually deliver those contracts on time in the current situation? And to me, that set of dynamic is the real problem, and I think that will be the absolute straw that breaks everything there, because if you look at the historical volumes last time and you look at the contracts coming off, specifically in the U.S. and Europe, that time frame is really the key driver. We know the demand's coming. That's not a problem. We know the thesis. We know nuclear is not going anywhere. So I think for us, answering the question, the quantities, can they be delivered? Can they build the mines in time? And can they deliver that yellow cake and the quantity that's needed, which means the price has to be higher. So I think that's, for us, that's kind of where we're hanging our hat.
Perfect. Thank you, guys. And that kind of concludes our user questions. So here's some final words from any final thoughts for retail investors. The question I get the most asked is, should you speculate in kind of the tiniest, crappiest companies and just hope that a rising tide lifts all boats? Or should you look at assets that can legitimately produce, go the full cycle? So if you want to kind of opine on that, and any last words you have for retail uranium investors.
Sure. Well, there's no doubt that in a rising price environment, and this is for any metal, any commodity, funny enough, the higher quality producers, the higher quality names, the higher quality assets will actually see far less leverage to the increased price. So generally, it's the low grade, very large deposits that see the biggest increases in value. So I would say crystal ball, then that could be a decent strategy to go for pure leverage. But honestly, myself included, there's a few of us that have been expecting this pull for a few years now. That's maybe an understatement. There's been, as I mentioned earlier, 4 to 5 head fakes just over the past 3 to 4 years in the uranium space. So I think investors should simplify and focus on quality. And to me, the easiest way to focus on quality is to back the management teams. There aren't many of them out there. Maybe there's a dozen that have actually had past successes in the U3O8 space and delivered value for shareholders. So I think, to simplify the investment landscape, look for management teams with sufficient skin in the game and those that have been in the uranium industry for 10, 20, 30 years, not kind of the guys that have popped in over the past few years because they see a potential bull run starting. As I mentioned earlier, I really do believe it's important to only buy common shares of companies that can go at least a year without raising capital. Otherwise, it's best to wait for those opportunistic private placements with 3 to 5 year full warrants, hopefully. As tempting as it can be, I guess in a best case scenario, you get the perfect world where you have a high quality management team or one that was active in the last cycle and delivered real value for shareholders, raising an opportunistic placement that includes a full warrant. That's the best case scenario for me. You get that optionality that's included with the warrant, but you're backing a team that has the experience to create real value. So it's a tough balance. The deal terms are important, but just because a company is offering a full 5-year warrant doesn't mean that you automatically jump into that deal. Make sure that management team is a group that you can trust and ones that have experience creating value within the U3O8 space. So I think that's how I would go about it. When in doubt, focus on quality to maybe 10 or 12 names that you're comfortable backing. Then take a look at them. For those that have 12 months more of capital on hand, and then consider buying common shares. For those that don't, sign up to their email list. Reach out to management, make sure that you're on the list for the upcoming placement, and then when they raise money, evaluate the terms, and then go from there. I know Andrew mentioned Deep Yellow is one of his favorite names in the space. That's one that's not a current holding in the MJG portfolio, but that's one that's certainly on our watch list. And next time they come to market, assuming they offer somewhat attractive deal terms, that's a deal that I'd be very excited to jump into because it's a combination of a little optionality because of a warrant sweetener attached to the deal, but also a highly experienced team led by John Borshoff, who's created tremendous value in the past uranium cycle. So you kind of want to check both of those boxes in my mind.
Perfect. Thanks so much, Matt. And then for Andrew, I kind of asked you the same question, and then also just kind of any final thoughts you wanted to expound upon.
Yeah, sure. So I think that folks at this point, so look, we've had all some good time to look at this sector and new people come in. So I stress that the new people need to get up to speed on things and do some research and get some information. But for those of us that have been around in the sector since 2016, 2017 onward, right now, I mean, we're still wrong, but when we're proven right, that'll pay for itself. And so I would just say that, and again, Matt hit on a number of points that I agree with really well. I think that folks need to have a total portfolio strategy that really gets the full spectrum of exposure. And that would include, in my view, you have to have some uranium producers, 1 or 2, and those producers got to be in a place that can potentially, obviously do well. Obviously, all of them probably are, but certainly of that producer exposure, you have to be in the U.S. with Section 232 outcome. So you need to have exposure to Section 232 via a producer. Globally, you might look at one other producer somewhere, maybe in Canada, perhaps. And then moving next down on kind of the food chain, a developer exposure. You need to find a developer that has a good chance of pulling something off. So look at a developer, and then next you need to move to discovery. Take a look at a company that has a potential good chance to discover something. Obviously, there's a lot of components to that. Management teams are obviously key. Typically, a good management team, if they have an asset, is because they believe there's something good there. Not a good management team is not going to take a piece of crap property and try to make something out of it unless they're just on the faker, joker, promotional side. So again, discovery upside, you got to select something there. And so that kind of covers the three categories. And then from there, there's some other stuff you got to look at that needs to be included in this strategy. The other piece is you need to find a company, if there is one, that has the all stage exposure, one that can discover, develop, and produce all in the same cycle. I think that is also a nice piece to add that could provide potentially some nice pop. And so you need to find a company that can potentially do that. Obviously, with that comes timing. And so timing is critical. In order to get that all stage exposure, you need to look somewhere that might have the timing set up to get you there. And so, of course, when you say timing, you might think of Africa. Obviously, Africa has some timing considerations that are much more attractive than other jurisdictions. So you need to look at that. The other piece is speculation, pure speculation. I mean, all these companies are more or less speculative, but some are more worthy than others, which, I would consider really investment. Energy fuels is certainly one that meets that investment standard. But nonetheless, you need to have a speculation of some kind. And so we've talked in the past about, potential speculations of, maybe new uranium countries that have not exported uranium before, that need that kind of framework in place for this particular company to make it out. Maybe it's a court case like Supreme Court, US. Maybe it's just a simple binary outcome. So those types, you need to maybe look at one or two speculations. And then obviously with all this, management team is key. You have to find a real proven management team. And I say everybody says that our team is proven. Well, that's not the case. So you need to look at that. And then at the end, you need to have some risk mitigation and you need to have an exit strategy to get out. And so those are the key pieces. So if you go back and you look at all those, that's going to add up to what Matt said, more or less 10 to 12 companies. And at the end of the day, make sure you have cash. Never give up your cash pile. Make sure you have plenty of cash because you never know what's going to happen. And so that's what I would say at this point. And then the last piece, patience. Again, this may not happen in 2019. It may not happen in 2020. So be prepared to wait a while. Be prepared to opportunistically employ that cash, whether we have a market crash, a broad market crash that drags these down. Be prepared with that cash to buy these stocks cheap. So that would be, if you listen to everything I just said there, I think you would have a pretty good grip on it. Now you just got to go out and find the companies that meet that strategy.
That's great, guys. And that concludes the podcast. And I just want to mention for disclosure purposes that nothing on this podcast that myself, Andrew, or Matt said represents investment advice. We don't know your particular investing situation, nor are we in a position to give you individual investing advice, and it's for entertainment purposes only. So I hope you guys enjoyed listening in. These are two gentlemen that really do have expert level knowledge of uranium. And they come in with a really, really deep knowledge of investing. And I think that combination is really, really key. So if you enjoyed what you heard today, please reach out to myself or feel free to send an email to Matt or Andrew and let them know that you enjoyed them coming on and sharing their knowledge with you today. So that's all we had. Thank you for tuning in.
If you like what you heard today, feel free to follow us on Twitter at InvestingUSS. We can also be found at USSinvesting.com, where you can subscribe to our email list and be up to date with any and all new projects we are working on. Right now, we're running our 7-day uranium course, which Matt and Andrew helped produce, so we hope you can enjoy that and join our subscriber list. So thanks for tuning in. USS Investing, the best content shared with the right audience.